Some of the world's leading money managers are warning the collapse of another American bank could lead to a credit crunch and an economic slowdown.
Earlier this year, we positioned for a slowdown in economic activity. But that view has been challenged on multiple fronts in recent weeks. Labour market conditions have remained very tight, and central banks have surprised the markets either with rate hikes or hawkish comments.
The good news is that the British economy grew 0.1% in the first quarter. And I say that and I have to smile because 0.1% obviously isn't that big, but it's better than 0.0 or negative.
We're still concerned about equity valuations at a time when you can earn a decent yield just by sitting in cash. But timing is important. And with labour market conditions still so resilient, we do not expect an imminent shift into recession this summer. And this reduces the risks to corporate earnings in the short term.
It shows the labour market is still hot and cooling more slowly than expected. It shows that the economy is more resilient than we thought. And that's a double-edged sword, of course, because it's going to spur inflation.
We now expect the slowdown in activity to be postponed to the end of 2023, as more resilient labour markets will support consumer spending. We've talked about how there are a number of structural factors behind tighter labour markets, but we also think that post-pandemic effects are lingering, particularly in the service sector, and this is leading companies to hoard workers. This also means that it will be harder for central banks to reverse the rate hikes and loosen monetary policy later this year.
Yeah, we've seen strength in the economy. I think there is good news in this. The economy has been more resilient, it's been stronger. We've got very low unemployment, but it is leaving us with inflation looking much more persistent.
So what are we doing while we await fresh trends? Well, we've reduced the extent of our defensive positions because they proved to be too premature. And we continue to be focused on earning yield from our exposures to European investment-grade debt and local emerging market debt. With markets caught between better than expected growth and higher interest rates, we don't want to oversteer.